In less than 48 hours, Nvidia lost more market value than most Fortune 500 companies are worth. Not because AI suddenly stopped mattering, but because for the first time in this entire boom, Wall Street had to ask a question it had been avoiding for 2 years. That question was, what if Nvidia isn't the only way to build the future? When Google quietly proved you could train a frontier AI model on its own hardware, no Nvidia chips required, it didn't just shake one stock. It cracked the story the entire AI boom was built on. December 2024. Google rolls out Gemini Ultra. On the surface, it looks like another step in the model arms race. Better benchmarks, slick demos. The usual AI launch cycle. But buried in the technical notes was the real earthquake. Gemini wasn't just competitive with GPT-4. It was trained and run almost entirely on Google's own chips, TPUs, inside Google's own data centers. No waiting in line for Nvidia shipments, no $40,000 per chip price tags, no dependency on a supplier that also arms all your competitors. In that moment, Nvidia didn't suddenly become a bad business. It just stopped looking like the only game in town. And when a company's been priced as if it's the new oil of the digital age, even a hairline crack in that story shows up as tens or hundreds of billions of dollars vanishing from the chart overnight. This isn't really a video about whether Nvidia goes up or down next quarter. It's about the pattern we've seen before, Intel, Cisco, IBM, and what it really means when the most powerful customers in the world start quietly trying to fire their favorite supplier. To understand why that crack matters, you've got to understand what Nvidia became over the last 18 months. This wasn't a normal tech rally. It was one of the fastest wealth creation runs in market history. Nvidia went from great gaming chip company to $2 trillion AI superpower in under 2 years. Faster than Apple's iPhone run, faster than Microsoft's cloud boom. At the peak, the logic was brutally simple. AI is the future. AI runs on GPUs. Nvidia makes the only GPUs that matter. Every serious AI player lined up. OpenAI renting tens of thousands of H100s. Meta buying them by the rack to train Llama. Microsoft hoarding supply for Azure. Amazon, Tesla, Anthropic, smaller labs, all in the same queue. Supply was so tight that startups were offering investors equity just to get earlier access to chips. Nvidia wasn't just a winner, it was a choke point, the one company everybody had to pay, regardless of who won AI. Wall Street priced it like that choke point would last for a decade. But choke points never last forever, not in oil, not in railroads, not in semiconductors, and certainly not when your customers are trillion-dollar companies who hate needing you more than you need them. While investors were celebrating Nvidia's quarterly beats, the biggest AI players on Earth were doing something very uncelebratory behind the scenes. They were building ways out. Google had been shipping TPUs since 2016, originally a niche internal project, suddenly the perfect escape hatch for the generative AI era. Amazon built Trainium and Inferentia to cut its AWS AI bill and reduce dependence on Nvidia. Meta announced its own MTIA accelerators, explicitly saying it wanted more control over cost and performance. Microsoft, Nvidia's closest cloud partner, started designing Athena, its own custom AI chip. Apple's been all in on custom silicon for years. Tesla built Dojo for its autonomy stack. Individually, each of these projects looks like optimization. Together, they're something else. They're the classic move you see every time a single supplier becomes too important. First, you pay up, then you grumble. Eventually, you integrate vertically and start making the thing yourself. Ford did it with steel and rubber. Apple did it when it ditched Intel. Now the biggest AI buyers are trying to do it with Nvidia. Not because Nvidia's hardware is bad, it's excellent, but because dependency is expensive, and power, over time, always flows away from the choke point and back toward the platform that owns the full stack. Gemini Ultra was the first loud proof that this shift isn't theoretical anymore. Here's where the numbers get uncomfortable. Nvidia's $2 trillion valuation wasn't just about how many chips it could ship this year. It was about irreplaceability. The unspoken assumption was simple. No matter how big AI gets, Nvidia will be at the center of every dollar of spend. But look at where most of that spend's actually coming from. A tiny handful of hyperscalers, Google, Microsoft, Amazon, Meta, Apple, plus a few mega labs. If even 3 of those giants successfully move a chunk of their workloads to custom chips over the next few years, Nvidia doesn't lose all its business. it loses something more important. It loses its ability to charge almost whatever it wants. It loses its aura of inevitability. It loses the narrative that AI equals Nvidia forever. And when a company's stock has been priced like a tax on the entire future of computing, even a small shift in that narrative can take a very large chunk out of the market cap. We've seen this exact movie before. Let's cut to Intel in the 2000s. It owned the PC world, until Apple showed what custom ARM silicon could do. Then there is Cisco in the dot-com bubble. It was seen as the backbone of the internet, until cheaper white box hardware and software-defined networking eroded its dominance. IBM in the mainframe era. It was synonymous with computing, until the PC, and then the cloud, made its moat look much smaller. In each case, the company didn't vanish. But the stock stopped trading like a monopoly on the future and started trading like a good, cyclical hardware business. Nvidia's crack is that same pattern showing up again, just in AI clothing. And underneath it all is the real question. Who actually controls the AI stack? Right now, the map looks something like this. Google, frontier models, custom chips, cloud, search, YouTube. Microsoft, OpenAI access, Azure, Office, Windows, and custom chips in progress. Amazon, cloud, custom chips, and a data fire hose from e-commerce. Meta, open sourcing models, building chips, and owning attention on social platforms. Apple, devices, custom silicon, and an on-device AI stack. Nvidia, the chips that powered everyone else's ambitions. Nvidia's original genius was to sit in the middle as a neutral arms dealer. It didn't have to win the app layer, or the cloud war, or the consumer platform. It just had to sell shovels to every gold miner. But when the biggest miners start building their own shovel factories, the arms dealer's position changes. They don't disappear. They lose leverage. The turning point isn't Nvidia crashes. It's Nvidia stops being inevitable. From here, the story isn't about who has the best single chip. It's about who owns the full stack. Hardware, models, data, distribution, and who ends up just filling in the gaps. History says the middlemen almost never keep all the value forever. Quick reminder before we go into what this means for your money. This is not personal financial advice. I'm not telling you to buy or sell anything here. This is context, so you can ask better questions about your own portfolio and your own risk. There are 3 big things to pay attention to if you've got exposure, directly or through index funds. First, concentration risk, not just stock risk. Nvidia isn't just another line item. At recent peaks, it's been one of the largest weights in the S&P 500, and a huge driver of returns in AI and tech ETFs. If the narrative shifts from AI monopoly supplier to very good, very cyclical chip company, that doesn't just hit Nvidia holders. It hits anyone whose retirement plan quietly leans on a handful of mega caps to do all the heavy lifting. Second, watch the behavior of the customers, not just the guidance from Nvidia. If Google, Amazon, Meta, or Microsoft publicly talk about ramping their own silicon and optimizing GPU spend, that's the pattern playing out. If, instead, they double down on Nvidia and shelve their custom chips, that's a different story. The market will obsess over quarterly numbers. You want to watch the direction of dependency. Third, margin and pricing power. The moment Nvidia has to cut price to keep volumes growing against custom chips, you'll see it in gross margins. That's usually when a this time different story quietly gets repriced back down to this is still a great company, but territory. Again, none of this means Nvidia's doomed. It means that a lot of the easy money in the AI equals Nvidia trade depended on a world where its biggest customers never seriously tried to replace it. And history suggests they always do. So let's pull it all together. Nvidia didn't fall because AI demand disappeared. It fell because, for the first time, the market had to consider a future where Nvidia is one of several ways to build AI, not the mandatory toll booth on every dollar of spend. Google proved you can train a frontier model on your own hardware. Amazon, Meta, Microsoft, Apple, Tesla, they're all racing to do the same thing. If they succeed, even partially, Nvidia's business doesn't go to zero. But the story it trades on, the story that turned it into a $2 trillion AI empire, starts to look a lot more like Intel, Cisco, and IBM. Still important, still profitable, just not the center of the universe. The deeper question isn't, should you buy or sell Nvidia? It's this how much of your financial future is tied to one narrative, that a tiny group of mega-cap stocks will keep defying gravity forever? Because whether it's AI, housing, dot-coms, or railroads, the pattern's always the same. The story looks unbreakable, right up until the moment it isn't. This is Money Margins. We make sense of the chaos so you can protect your future. So, what do you think? Is Nvidia the next Intel, or is this crack just another pause in a much bigger run?